fact of the matter is that the way a normal person likes to think about debt is kind of derived from our Judeo-Christian backgrounds as a culture, in that debt's bad, more debt's worse, too much debt, you go to hell. Someplace in between there, you buy a variable annuity. I don't know. Anyway, that was a joke. If you didn't get the joke, that's okay. It's pretty hard to think of me as not being a joke when it comes to the issue of the topic of variable annuities. But the visual that you have is showing you a history from 1960 to the present of interest payments as a percent of U.S. GDP on federal debt. And what you see is that we're currently at the levels that we were at back in 1960. We rose into the 80s and then flattened out at levels that were twice the level we're at now, where we had less debt than we have now, but relative to the size of the economy, not as much less as you think, and interest rates were very much higher. Now, with interest rates down so much, and debt as a percent of GDP markedly higher, but not that much higher, the interest payments are completely manageable. Could they become unmanageable in the future? Yes, and of course. Will they? I don't have a clue. Can we calculate what it would take to do that? Yes, and that's part of those visuals that you see that we often elaborate on in our in-person client seminars. But the fact of the matter is, in any time frame that markets care about, is not going to be a problem. When I say any time frame that markets care about, a basic rule is that markets only care about things that are coming at us in the future that's in the approximate next 3 to 30 months. Anything further out into the future than that, markets aren't going to believe until they get closer. Anything that just happened, markets a speed bump to. And this, to get debt to levels that are problematic, it's going to take a long time from here. Can it happen? Yes. Will it happen? I don't know. If I had my druthers, if I was running the Treasury, which hopefully would never ever happen under any circumstance, I would take our debt right now, counter to what our government's doing and counter to what our prior administration did, and do what Secretary of Treasury, Mnuchin, said he was going to do when he first got appointed, but has not been doing, which is to extend the maturity at today's interest rates out as far as much as he can into the future, because if you could lock in today's low interest rates, we don't have a debt problem for a really long time in this country. The more we do what we're doing, which is backwards, which is rolling long-term debt into short-term debt because the short-term interest rates are so low, the more you build a world where if short-term rates go through the roof, it could become a problem faster. But be that as it may, I can't predict what will happen with all those things in the future. It's all going to be too far to impact 2018 stock markets. We can metric it, we can measure it this way, that way, the other way, in 7 ways from Sunday, but it's not going to be a stock market problem in the immediate period ahead that we have to deal with in the next year, and we will continue to measure it, monitor it, and you can ask the same question again when we do this the next time.